So good morning, everybody. We're going to press straight on. The Minister is already here for the next session, so we are aware that we need to be prompt. I would just like to say that for all those in the room who happen to be called Dimitrios and Dimitra, I'm aware that today is your name day. So Chroniapala, if I've got that right. Also acknowledging that this is an important day for Thessaloniki, celebrating liberation of the city. So we've never had this conference so late in the year, so it's the first time we have an opportunity to acknowledge this. So we move on in a very similar theme to continuing the conversation in a sense from what we've just been hearing. I'm joined by Gikas Hardouvelis, Chairman of the Board of Directors of the National Bank of Greece, Professor of Finance at the University of Piraeus, and of course you were Finance Minister in those days that we've been hearing about another Greece, we just heard Andrea saying, and since then, of course, a great transition, which I think you were instrumental in getting underway. And Colin Ellis, Global Credit Strategist with Moody's Investment Services. Welcome to you both. We're really going to focus on the macro situation first. It seems extraordinary now to look back at those terrible times of the global financial crisis, and we've been hearing about the extraordinary turnaround case study that Greece represents. But is all this really in the rearview mirror, is the first question, or could something similar happen again if you survey the global and in particular the European landscape? Start with you, Gikas.
Well, Dan, I think you put your finger on the right spot. I think it is in the rear view mirror. I don't think the probability of having another huge crisis like the one we saw back in 2007, 2009 can happen again with the same ferocity. And there are many reasons for that. At that time, the primary reason for the crisis was the fact that banks were over-levered, the private sector was over-levered, corporates. You had a real estate bubble that burst. And more important, what had happened, the banks had taken advantage of an innovation of how to spread risk away from their balance sheet. So they forgot about of how to lend and how to examine their customers. Essentially, they would lend and then they would distribute. They would sell their loans, but the tranching that took place, the market learned of how to separate different types of risk and package it and sell it, but they overdid it. Banks didn't worry so much about credit risk, and that's how we reached the crisis, I think. That's gone. Right now, I mean, rating agencies, for example, became very smart, trying to watch out for these things. But primarily, the regulators got involved. We had Basel III after 2009. In Europe, in the effort to form the banking union, we have institutions like the SSM and the FRB that are on top of the banks. So banks are well capitalized now, which means they have low leverage, and they also are quite liquid. There are rules on liquidity. So the banks are doing well all over Europe. In fact, the Greek banks are doing extremely well. In the stress tests that were recently announced in July, and the SSM does them every 2 years. The Greek banks were like, all three of them were like among the top 20. My bank was the 5th among all the banks. So there's definitely, at least the financial sector is more stable. If a crisis is to occur, it may occur from another place, and most likely the non-bank financial institutions. That sector has grown in Europe from like handling about 15 trillion euros back in 2007. Now they they have doubled in size, about 30 trillion, and they're not regulated. We don't know if they're levered. So if something happens to them, it might interfere with the banks if the banks are involved with them. And they are, some of them. So you should never say we're not going to see another crisis, but I think we can handle it now. The other item that's different now, we have restrictive fiscal and monetary policy. The global economy is in a sort of recession, kind of. That can affect the banking sector, but it's not going to create a crisis situation. That's what I think.
So that's reassuring, but I think it's helpful that you put your finger at just a sort of little glimmer of where the next crisis might come from if we're not careful. And just to follow up on this non-banking financial center, do you have any sense of what should or could happen to guard against that? Because it's quite easy to see how you regulate. There's been a lot of thinking and control through the Basel process and on the banking sector, but how do you begin with the non-bank financial sector?
That's a problem. I guess in Europe, we should begin in agreeing between the countries of the definition of a bank, because we don't have the same definition of a bank. When you talk about the non-bank financial sector, you're talking about not only traditional investment funds or pension funds that you kind of know them, you know what they do, but anything that's new. The new fintech companies are trying to enter the banking sector, and they're trying to lend. Some of them do lend overnight, and they're trying to take the low-hanging fruit without being called a bank, and therefore without being under the auspices of the regulator. That's a problem that the regulators have and the politicians have to worry about. How do you actually create a perimeter around institutions that actually take deposits and also lend at the same time? If they do one of the two, they're not called a bank, and then you cannot control them. So somehow you have to do other things. But this is not my problem. My problem, I represent a bank.
Well, it could affect you. That's the thing.
It could affect. Me, I worry. I definitely worry about counterparty risk. We're checking all our counterparties. Definitely, we do that.
So, Colin, I think that's a good segue to you and the rating agencies, and whether you can monitor this. And is this on your radar screen? And feel free to also mention other things that are on your radar screen with respect to potential crises of the future.
Thank you very much, Daniel, Professor. It's wonderful to be back here in Athens. I think it's right that we broaden our focus beyond the banking sector and think about what we call NBFIs, or non-bank financial institutions. I agree the definition is a bit blurry from place to place. But I think I'd make a couple of points just to remind us all why banks are so important. Firstly, with everything we've seen over the past 13 or 14 months, it's still been the banking sector where we've seen pockets of risk crystallize. So we cannot forget about Silicon Valley Bank. We cannot forget about Signature Bank. Credit Suisse was another very timely reminder that banks can fail long before they get anywhere near insolvency. Banking remains a confidence game. You have to persuade your customers and your investors that you will manage your risk effectively. And if you lose that confidence, then very quickly you can fail. And banks still play roles that are incredibly different from the non-bank parts of the financial sector. So, when I think about direct lending, for example, which NBFIs have done a lot of, private credit, investment firms and companies lending money directly to businesses in a intermediated way, but not in a transparent way like banks do. Yes, of course, we see the risks there, and we worry about the ability of some of those players to manage their portfolios, particularly given the explosion in direct lending over the past 2 or 3 years. We worry a bit about how transparent they are about defaults, to be entirely honest, because we're pretty clear about what we call a default. Sometimes I think things that we would call a default, they won't, so we worry about the comparability of data. But even if you saw an issue there, the fact remains that NBFIs do not create money. Banks do. That's the nature of the way that banking works in advanced economies nowadays. And they are also not as embedded in the infrastructure of the financial system, and particularly payment systems, as banks typically are. So, of course, we worry about risks everywhere, but I think there will always be good reasons why we focus on the banking sector with regulation. In terms of what needs to happen going forwards, my focus at Moody's is really about how these inherent problems in particular parts of the non-bank sector could become systemic. So, let's just be absolutely clear. If you believe in some aspect of a market economy, you believe in the freedom to lose your money for a risk to crystallize and you suffer a loss. That inherent risk in and of itself is exactly what economies should cope with. Whether that becomes systemic either through counterparty risk or through triggering asset price declines elsewhere, or through a general shift in contagion around risk appetite from investors, those are the kinds of channels I think we need to worry about.
And is there any one of those channels in particular that you have your beady eye on right now?
The one that worries me the most is the contagion channel, because you can have an issue, you can have a problem in one part of the sector which may be totally unconnected in a direct way to another risky asset in another part of the financial sector, but it still has the potential to trigger correlated asset price declines, which then can fill into fire sales and other issues. And that kind of psychological linkage is incredibly hard to deal with. We had a mini government in the UK last year, and one of the reactions to their budget measures I would characterize in that kind of form. And that's where, to pick up on one other big change since 2007, 2009, I think the shift from policymakers has been incredibly important. And with Credit Suisse, with the US banks, we saw policymakers step in very quickly. With the gilt market meltdown in September, October last year, we saw the Bank of England step in very quickly. And in all three of those instances, they weren't following a prescribed rule book. The US extended deposit insurance, the Swiss rewrote the rules on Sunday night in terms of changing the law. There was no playbook for the Bank of England. So I think the emphasis on responsive policymakers as guardians of financial stability is also a positive.
Speed. Things happen very fast.
Yes.
Gikas, one of the big worries currently has been and continues to be inflation. How long do you think this is going to hang over us as one of the major concerns? And where are we in this battle against inflation?
I'd say we're not going to, I think inflation already started declining, core inflation less fast, but already started declining. But I don't see going down to the very low inflation rates we saw the last 10 years. The world has changed. If I try to forecast 5 or 10 years ahead, I can see investment demand rising, for example, because of the environment. I can see essentially, that will be the biggest driver of inflation. And also, the world is being fragmented. We have lost the globalization momentum. We're more or less stagnating. We're being fragmented the last 5 years. And China used to be the locomotive of growth, and China is no longer growing as much.
There's not much. You may have deflation in China.
You may have deflation in China, but in every other country, there are supply side issues, and all these supply side issues imply rising prices. I see the supply side becoming more important in the future. So if I were to look in the longer term, I think people start thinking that perhaps a 2% rate of inflation may not be optimal. Central bankers, some economists are talking about raising the bar from 2% to 3%, although that's kind of dangerous because it involves issues of credibility, and I don't necessarily recommend it. But in general, I think we're moving into an environment of I think, higher inflation. Now, that also implies higher interest rates. And I see not only the inflation premium in nominal rates rising, but also the risk-free rate rising for two reasons. The real rate rising. The real rate rises because the risk-free rate is likely going to rise, and also inflation, also risk premium is going to increase. Risk in general is much larger globally, exactly because of geopolitical tensions and the split between countries. That drives up the risk premium, that drives up the real rate. And then on top of it, you have inflation risk and inflation risk premium. So that's how I see the world 5-10 years ahead.
What's the optimal
in the
rate
meantime,
for a bank?
in the meantime, it's all going to be what the ECB and the Fed will do.
Can I ask you for a bank what the optimal rate is? Because, I mean, to some extent, the bank's profits have benefited from inflation, clearly.
Yeah, the banks, well, the banks that are actually managed well, they actually profit from an increase in interest rates. In the last 6-7 years, we had very low rates, even negative nominal rates, and this was bad for the banks. It was very hard for them to operate. It was very hard for them to do the disintermediation role. Now that interest rates normalized, Greek banks at least became profitable. Things became normal. Now, where banks could lose by when rates are jacking up and abruptly is if they haven't hedged their bond portfolios. Banks that are not hedged, properly run, they run into risk. Greek banks actually behaved well. We saw it.
Colin, your view on inflation?
It's perhaps not quite as negative as Professor Hardouvelis, but it's similar. I mean, this is, if the global financial crisis was a test of financial stability, which I think with hindsight we'd say we probably failed, this episode right now is the global test of inflation targeting. And it is an existential issue for independent central banks. So although we're through the kind of peak rates of headline inflation, and probably through the peak core inflation rates, we think the challenge to get inflation all the way back down to kind of 2% targets in advanced economies is going to be a difficult one. And that's why we see monetary policy as remaining tight, probably all the way through to 2026 here in Europe. Because I don't think central banks can afford to lose this battle. I think if we accept...
They're going to stick to 2% as the target, or thereabouts as the expectation?
I think so. I mean, from country to country it varies, of course, because in some countries or some regions, the central bank defines their own definition of price stability, and the ECB does that here in the euro area. The Fed does it in the US. In the UK, for example, the inflation target of 2% is decided by Parliament. So the institutional arrangements differ, but I don't honestly think they can contemplate moving away from 2% right now, because it would become a self-fulfilling prophecy in terms of expectations. And also, as the professor said, it would be incredibly damaging for credibility.
Yeah.
So we think we've kind of done the easy bit now. You know, headline inflation's come back down, but it will be more of a grind to get all the way back to 2% around the world. And that's why we think policy will remain tight. If we are moving to a world where we are happy to accept 3 to 4% inflation with higher interest rates as well, that's a very different world, and it matters an awful lot for us because institutional strength, the ability to do what you said you were going to do, is incredibly important when it comes to assessing credit. If we're in a world where now there are more question marks and more doubt about your ability to deliver, there's more risk.
So, as in so much else, it comes down to a question of trust, I think, and
yes.
Credibility. To finish, I want to turn our attention to Greece and the prospects for Greece, and particularly the financial outlook for Greece. We've heard some very rosy discussions now. Do you share this rosy view? And what are the risks for Greece? What's the glass half empty scenario for Greece?
Oh. Okay, well, I think I'm optimistic about the country. And the fundamental reason for my optimism is the fact that I think the country has matured. It went through a huge crisis, and it made both politicians and the public realize that the public sector is not invincible. It's not there to distribute goodies, but you don't only have demands from the public sector, but you also have obligations. And then the Greek citizens finally connected the payment and their wages to the taxes. When they see demonstrations out for asking for more wages, immediately they grab their pocket because they know they're going to be taxed for it. They didn't do this before. So also during the crisis, we did a lot. We have a well-organized tax office, independent tax office. We have digitalized a lot of the public sector. I think people spoke about this before. And also, we're lucky to have political stability. Political stability is a must if you want to do things, if you want to continue to reform the country. I mean, you can see that all the fiscal issues that Europeans worry about now and about the Stability and Growth Pact, it doesn't touch the Greeks, because the Greeks know they have to generate primary surpluses for a long time. They have a huge debt to GDP ratio, but they are doing well. They brought it down. It's already at the end of 2023, will be at 160% of GDP, and it was like 200% 4 years ago. And it's still going down, and by 2025, we may even do better than Italy. We will have a lower debt to GDP ratio than Italy.
Maybe shouldn't be the best target to have, but anyway, but that's another.
Anyway, so all I'm saying is I sense seriousness in the whole, in all the country. If you read the media, they don't nag about little details. They understand the fiscal situation is something you have to do. It's a major constraint. You have to abide by it. And then the other thing that's a plus is that finally, if you're at the bottom, there's one way to go up, and we are in that trajectory. Capital investment is going up. We have FDI coming into the country. The RRF is kind of providing insurance that investment money will flow in. The Greeks were among the best in trying to attract the funds, and actually have already distributed some of the funds. It looks like the country has its act together, in other words. Of course, and the financial sector, I guess I talked about it before, is very stable. I mean, the NPE ratio is like almost around 5% now in the country. It used to be 50%. And yes, a lot of the NPEs are within the economy, but and somehow there are some individuals that have to still handle their obligations, but the owners of those funds are not Greeks. I mean, the risk is outside the banks, and it's outside Greece itself. So I don't consider it as a major issue. What are the risks? There are always risks. The risk is, can you continue reforming the country? Because, the cost of reforms, a political party sees it today, but the benefit comes later. So we need to push, especially on delivering justice quickly. We need to push on tax evasion still exists. Our VAT gap is declining, but still among the highest in Europe. It's like we're missing about 18% of VAT taxes. We know there is underlying economic activity, and we should have gotten that VAT, but somehow we're not getting it. And we're getting better at grabbing it, but we're still not there. The biggest problems, I think, for Greece, which are common European problems, is demographics. They're not problem of the next 5 or 10 years, but it's looking forward because a country is strong, is economically strong, and it's also politically strong if it grows, if the population grows, and if it's able to kind of become increasingly more and more self-sufficient in what it does. That's a
very fundamental
thing, which is not only Greek. I think that's part. And then the reform issue, I think I'm optimistic on that because the politics are right and we can do the reforms. I don't know what other.
That's all right.
I don't expect financial
We're running
risks.
out of time. I want to give Colin one last chance. We've heard a lot just in the previous session about the investment grade from S&P. What about Moody's?
We're not quite there yet. We are rating Greece at BA1, but I think I agree with the whole tone of this conference. There's been a lot of progress so far. There's more that needs to be done, and I'm optimistic the more will happen. In terms of what we might look for, on demographics, yes, Greece has challenges, but there is an opportunity, particularly to boost employment among young people and women, which would help counter some of that effect. There's work to be done there. The efficiency of the judicial system could also be significantly improved. And my feeling is, given that there is this strong consensus around fiscal sustainability and bringing that debt burden down, the biggest risk might be not making the most of the opportunities that Greece has, particularly with the once-in-a-generation opportunity presented by Next Gen EU and the Recovery and Resolution Funds. We think that those could boost trend growth in Greece in the 2030s, so not just a short-term spend it and get the benefit, by almost 0.5 percentage point a year. Now, that may not sound like a lot, 0.5%, but actually, in the context of 2% trend growth or 2.5%, depending on where you are, that is massive. So I think delivering on that or failing to deliver on that might be the biggest thing.
But that's a fairly sort of medium-term horizon. What in the short term, what are you looking for? What would be the indicator in Greece that would shift the rating for?
So it's everything we've talked about at this conference already. It's continued focus on the primary surpluses, bringing down the debt to GDP ratio. It's focus on further reforms to really improve the efficiency of the economy as a whole and boost inclusion, particularly in the labour force. But at the moment, I think my message is we are already at a point where some of the big risks that we saw in Greece have gone away. So people talk a lot about investment grade ratings, but frankly for us, as soon as you have a BA rating, we are signalling that you are not a significant risk of default. So investment grade means one thing, but BA means that you are safe if we're doing our job well. Greece was there in 2020, okay? So we have been signaling positive things about Greece for some time. I expect that progress to continue.
Very good. Well, very briefly, yes.
Can I ask him a question?
Go on, very briefly, because we are short.
Very briefly. I've been watching rating agencies for 30 years now, and I used to remember that Moody's was the most sort of lax kind of, was always very optimistic about Greece. And now it has become the most stringent. It's like, I see it like you only recently put Cyprus, for example, to investment grade, whereas S&P had already put Cyprus in 2018. And you're the last ones to upgrade Greece. What is it? Is it you have changed your policy? You become very strict? You are the strict? Do you want to be the champion of strictness among the rating agencies? Or you have a different philosophy than the other rating agencies? I'm just curious. I mean,
No, it's a great question. I have no desire to be the champion of strictness, but it is true that, particularly after the global financial crisis and what we saw in terms of securitizations, but also the European debt crisis, where Greece was single A 5 years before it defaulted twice, Cyprus was double A 5 years before it defaulted, we had to fundamentally rethink the way that we did ratings, both for banks and for structured finance and for sovereigns. The corporate rating performance was much better, but one of the things that I think we are very focused on, and the group that I lead at Moody's produces and publishes the data on this, we absolutely hate adding to noise in financial markets. So I think we put more weight on avoiding rating changes that are then reversed. And if you look at some of the other rating agencies out there, they can talk for themselves, I think they have a slightly higher propensity for that. So that is one difference. But it's also true that we are independent. We have our own rating methodology. We have our own approach. And that means sometimes there will be differences.
Okay, I have a sense that this is a conversation that will be continued in the bars afterwards. Thank you very much to both of you. That was a fascinating session. Thank you.